I need you to stop what you're doing right now. Turn off the television, close the social media apps, because what I'm about to walk you through is not speculation. It's not opinion. It's not theory. This is a forensic reconstruction of a coordinated financial operation that took place over the last 72 hours while most people were asleep. If you own silver, if you're considering buying silver, or if even a single dollar of your retirement savings is exposed to this market, the next 20 minutes matter. They may determine whether you make it through what's coming or get wiped out by it. Ladies and gentlemen, this is Asian Guy. Today is Monday, February the 2nd, 2026. And the financial war we've been warning about just went kinetic. The smoke is clearing, the damage is being assessed, and the evidence left behind is impossible to ignore. We're going to walk through the scene step by step. We're going to identify the weapon. We're going to expose the motive, and we're going to show you the fingerprints left behind by one of the most sophisticated takedown operations the commodity markets have ever seen. Let's start with the number that defines the battlefield. As of 4:27 a.m. Eastern Time, silver is trading at a bid price of $79.89 per ounce on Kitco. The ask is $80.14. That's a single session collapse of 635, a 7.46% drop in just hours. The intraday low during the carnage hit 77.53. The intraday high before the hammer fell was 84.18, nearly a $7 swing in a matter of hours. If you're a casual observer, if you just glanced at the chart this morning and saw red, you probably shrugged and told yourself this was a normal pullback. You probably thought it ran too far, too fast. Of course it had to correct. That explanation is wrong. Completely wrong. This wasn't a correction. This was a surgical strike, a planned demolition. And the blueprint is sitting in plain sight if you know how to read it. Gold didn't escape either. Gold collapsed to $4,672 or $60 on the bid, down $216 to $80, a 4.43% drop. The intraday low touched $4,444. The high before the collapse was $4,885, $70, nearly $500 of volatility in a single window. When gold and silver are crushed simultaneously with identical timing and identical aggression, that's not a market event. That's a message. Someone fired a warning shot across the bow of every bullion holder in the West. So who pulled the trigger, and why now? To answer that, you have to understand the terrain. This crash didn't happen in a vacuum. It came on top of the most extreme silver rally in modern history. Go back just 30 days. 1 month ago, silver was trading in the low 30s, 32, 35, quiet, stable, boring. Then something changed. And it wasn't retail. It wasn't small speculators. It was institutional money, central bank money. The kind of buying that moves hundreds of thousands of ounces at a time. Silver climbed through $40, $50, $60, then $80, then $100. And for a brief moment, it touched $121. That was the intraday high, the summit, and that's exactly where the explosives were detonated. You need to understand what $121 represents. That price level is an existential threat to the legacy financial system. At $121, the synthetic paper contracts written by bullion banks, the promises to deliver metal that doesn't exist, start collapsing under their own weight. Shorts bleed, clearinghouses panic, margin calls explode. At $121, the game ends. The illusion breaks. They could not allow it to stay there, so they slammed it down, hard, fast. Violently enough to terrify retail holders into dumping positions. What you witnessed was not organic selling. It was engineered fear. And here's the proof of coordination. The sell-off began simultaneously on two exchanges that should never move in perfect sync. COMEX in New York and the Shanghai Futures Exchange. Two markets separated by thousands of miles, different regulators, different clearing systems, different participants, and yet they collapsed together. At the same moment with the same intensity. That doesn't happen by chance. That requires coordination. That requires power. Only a handful of entities on Earth can pull that off. One is the Federal Reserve and its primary dealer banks, J.P. Morgan, Goldman Sachs, the usual names, with the motive of protecting the dollar. Another is the Chinese state apparatus, which has been stockpiling silver for years. And the third possibility, the most dangerous one, is cooperation. Suppress price in the West. Accumulate in the East. Everyone wins except the public. Now let me explain the weapon. It's called a margin hike, the nuclear option. When you trade futures, you don't pay the full value. You post margin, but the exchange can raise that margin at any time, overnight, without warning. When they do, traders must immediately wire massive amounts of cash or be forcibly liquidated. That's exactly what happened. COMEX raised margin requirements to levels that effectively forced anyone without institutional balance sheets out of the market. Shanghai appears to have done the same. Traders had no choice: sell or be wiped out. When thousands of forced sell orders hit the market simultaneously, price collapses. That's not supply and demand, that's engineered capitulation. And while that was happening, the same institutions that benefit from lower prices were waiting on the other side, buying. They crushed price, then scooped up contracts at $79 that were trading above $90 days earlier. This is the playbook. They shake the tree. They collect the fruit. Now listen carefully to the story they're going to sell you. You'll hear phrases like healthy correction, profit-taking, technical retracement. CNBC and Bloomberg will roll out calm analysts who explain that the market got overheated. Do not believe it. This was not profit-taking. This was panic manufacturing. Because the fundamentals didn't change. Industrial demand didn't disappear. Solar production didn't slow. EV manufacturing didn't pause. Supply deficits didn't resolve. The only thing that changed was the paper price and paper lies. Here's the crack in the system. While futures prices collapsed, physical premiums surged. Dealers report rising premiums, empty shelves, backlogged refiners, mints running at full capacity. In some regions, silver isn't available at any price. Explain how that happens during a crash. You can't unless the screen price is fiction. So here's the question that matters. Do you trust the number on the screen, or do you trust physical reality? Because this disconnect cannot last. Either paper prices gap violently higher to match scarcity, or the futures market breaks and physical trades in a separate universe. Either way, paper holders lose, metal holders win. Solar alone guarantees higher prices. Every solar panel requires silver, no substitute. The IEA estimates solar will consume over 200 million ounces annually by 2030. That's over 20% of global supply. Add EVs, add 5G, add electronics, add medical demand. The deficit is structural. Industrial buyers don't trade on margin, they pay cash. When price drops, they buy more. Every smash drains inventory further, vaults empty, registered ounces decline, the system tightens. And silver isn't just a commodity, it's money. It always has been. When currencies fail, silver survives. The dollar is weakening, debt is exploding, the Fed is trapped. Inflation is real, no matter what the official numbers say. The math doesn't lie. This is why the violence is bullish. They're desperate, they're buying time. But time is running out. Short term, expect volatility, expect suppression attempts, expect propaganda, but physical demand isn't going away. Eastern accumulation isn't stopping. Eventually, metal runs out. When that happens, there's no smooth transition. There's a break. And here's the truth. $79 isn't a warning. It's an invitation. I'm not selling. I'm not panicking. I'm calculating how much more I can stack before the window closes. Because this wasn't a correction. It was a clearance sale forced by entities terrified of what a free silver price would expose. When the system cheats, it means it's losing. Hold your metal, ignore the noise, watch the physical market. The price is $79. The crash was coordinated. The end game is inevitable. Like, subscribe, share.